Most people do not realize they are being taxed in the wrong order. That is the first thing I want burned into your mind. They think the government takes its cut because that is simply the way adult life works. You earn, you get taxed, then you try to stretch what is left over across housing, food, insurance, transportation, children, health care, and every other cost of staying alive. That feels normal. It is normal. It is also exactly why so many people stay stuck, because when you accept that order without question, you spend your whole life playing defense with after-tax dollars, and after-tax dollars are weak dollars. They are dollars that already survived the first bite. The people who build serious wealth do not merely earn more. They often change the order. That is the real trick. Not some hidden offshore scheme, not some fantasy loophole. Only billionaires understand. Order, sequence, structure. The source document says this very plainly. Most people pay tax first and then use what is left to pay expenses. But people with the right type of income structure often deduct qualifying expenses first and then pay taxes on what remains. The source even gives the simplest version of the math: earn $10, lose $3 to tax, and spend $7, or deduct $7 first and let the government tax the smaller remainder instead. That is the whole psychological shock at the center of this conversation. Fay file a site, Fay turn 39 file 0 Fay. That is why I do not think of this subject as write-offs. I think of it as tax sequencing. And tax sequencing is one of the sharpest knives in the entire financial world. The reason so few people use it well is that they still think like employees, even when the law is quietly rewarding business behavior. Employees live inside withholding. Owners live inside structure. Employees ask, what do I owe? Owners ask, what counts as ordinary and necessary? What entity or activity gives me the right treatment? And how do I make sure my expenses are flowing through the correct pipe before the tax bite lands? That is a completely different mindset. And if you do not make that shift, you will keep paying for your life the expensive way. So let me give you the master metaphor for this entire story. I call it the tax waterfall. Most people stand under a waterfall with a bucket. The income falls. The government grabs the first and biggest share. Then the ordinary person runs home with the remainder and starts pouring it into rent, gas, meals, medical bills, childcare, internet, and everything else. The water always feels too small because it has already been chopped down before real life even starts asking for it. The owner does something else. The owner builds channels upstream. The flow still comes down. But now some of the water is legally diverted into the pipes that support the trade or business before the government counts the final pool. That is the difference. Not magic, not cheating channels. And if you want more of your life funded with pre-tax dollars instead of after-tax dollars, you have to understand where those channels are and what the law actually requires. The source starts exactly where it should. Section 162 of the Internal Revenue Code, ordinary and necessary expenses paid or incurred in carrying on a trade or business. That is the gateway. It also makes the next point clearly: you do not need a glamorous storefront or a formal office tower to have a business. Non-employment income in many forms can qualify if you are actually carrying on a trade or business. Side gigs, 1099 work, rental-related activity, affiliate income, delivery work, and other non-2 income streams can all become the platform from which deductions begin to make sense. Fay file a site, Fay turn 39 file 0 Fay. This is a very important identity shift. Most people hear business deductions and assume they are disqualified because they still think of business as something larger, more official, more distant than what they are doing. That misunderstanding costs them dearly. The law does not care how impressive the business sounds at dinner. It cares whether the activity is real, whether the expense is connected, whether it is ordinary and necessary, and whether you can support the treatment. If someone asks, that is the difference between smart tax planning and fantasy. The fantasy is that you can wave a business card at ordinary life and turn everything into a deduction. The smart version is much more disciplined. You build a real activity, you understand the rule, then you route the right expenses through the right structure. That is what this story is really about. And I want to take you through the major channels one by one, because once you see them as part of one integrated system, the whole thing stops feeling mysterious. The first channel is housing. This one shocks people because housing is so big, so familiar, and so deeply assumed to be personal that they rarely stop to ask whether part of it can be converted into a business cost. The source says the IRS allows deductions tied to the business use of a home when part of the home is used exclusively and regularly for the trade or business. It gives the straightforward example of using a room as an office or a basement or garage for storage or business work, and then allocating a percentage of total home costs based on business use. It notes that rent or mortgage-related amounts, utilities, Wi-Fi, and even some maintenance expenses can be partially captured through the home office deduction. Fay Filicite Fay Turn 39 File 0 Fay. This is why I call housing the square foot channel. A lot of tax planning comes down to one brutal truth. Life is full of fixed costs. If you can legally route a slice of a fixed cost into the business system, the economics of your entire household change. That is what the home office does. It does not make housing free. It makes part of the cost useful. And useful costs are much better than dead costs. Let me say this even more bluntly. If your home is functioning partly as a production site for the activity that earns your trade or business income, then pretending the cost is purely personal may be financially lazy. The source gives the simple example of a house costing $50,000 a year to maintain, and a 10% business use share producing a $5,000 deduction. Whether your actual figures are larger or smaller, the principle is the same. Space can become tax geometry. Fay Filicite Fay Turn 39 File 0 Fay. Now, discipline matters here. Exclusive use means exclusive use. This is exactly where careless people get themselves into trouble. A room that is half guest room, half hobby space. Half office in your imagination is not the same thing as a clearly defined business. Use area in reality, the source stays fairly high. Level on this, but the implication is obvious. This deduction is powerful because space is expensive. That is why sloppy people overreach. Do not do that. Clarity is what makes the deduction durable. And this housing channel has a second lesson inside it. A home is not just where you live for many modern business owners and side income earners. It is also where value is created. That means housing no longer belongs only in the lifestyle column. Part of it belongs in the productive column. That reclassification is one of the most important mental upgrades a self-employed person ever makes. Now let us move to the second channel. Vehicles. This is where people get emotional quickly, because the vehicle deduction has become half myth, half bragging culture online. That is unfortunate, because the real rule is both more boring and more useful than the nonsense people repeat. The source says the tax law allows you to deduct vehicle use when the vehicle is used for a business purpose, and that when the use is more than 50% business. It may also qualify for accelerated write-off treatment under current depreciation rules. It then immediately says the most important part out loud. There must be a legitimate business purpose. And the use case has to make sense for your exact business, delivering products, meeting contacts, traveling between valid business locations, and other clearly related uses are the key. Once that foundation exists, either actual expenses, including depreciation, or a mileage-based method, can come into play. Fay Filicite Fay Turn 39 File 0 Fay. That is why I call vehicles the motion channel. Cars do not become deductible because they are expensive. They become deductible because movement can be a business function. That is a profound difference. The average person buys a car for life and then wonders whether life itself can be turned into a tax break. But motion in service of business can. This matters because a vehicle is one of the largest recurring cash drains in many households. Payment, insurance, fuel, maintenance, depreciation, registration. It is an expensive machine. If that machine is genuinely carrying part of your income generating activity, then again, a fixed personal burden begins to transform into a productive cost. That is what owners do. They look at what life already requires and ask whether some of those requirements are also supporting the money engine. If yes, they route the cost accordingly. Now I want to push one step harder here. A lot of people want the sexy version of this topic. They want to know how to write off the largest possible vehicle immediately. That is the wrong instinct. The right instinct is to understand your actual business use and your documentation. The deduction belongs to the function, not to the fantasy. That is why I care much less about the truck write-off mythology than about the actual operational question. What work is the vehicle doing? How consistently, how credibly can the use stand up under common sense? Because that is what makes the channel legitimate, not internet swagger. Now let us move to the third channel, meals. This one is another area where people swing between two wrong extremes. Either they assume every lunch can become a deduction if they mention business for 30 seconds, or they assume nothing is deductible unless it happens in a boardroom with 3 lawyers present. The source gives the right middle path. A meal can be deductible if there is a real business purpose and a business contact is present, such as an employee, partner, client, or prospective client. It also notes that the contact can even be a close friend or family member if that person is genuinely affiliated with the business. The principle again is not glamour, it is business connection. Fe phalocite fe turn 39 file 0 fe. That is why I call meals the conversation channel. A meal is not deductible because food is magical. It is deductible when it qualifies because commerce often happens through conversation. Deals are not made only in spreadsheets. Relationships are not built only in meeting rooms. Business development, planning, negotiation, prospecting, and coordination often happen around tables. That is the logic. And once you understand the logic, the rule becomes much less mysterious. The government is not subsidizing your appetite. It is recognizing that some meals are part of the process of running a business, that distinction matters, because people who do not understand the logic tend to get sloppy. They start treating ordinary life like lightly disguised business theater. That is not what you want. What you want is clean connection, a business purpose, a business person, a record. That is how the conversation channel stays strong instead of drifting into fiction. And there is a second benefit here that people miss. Meals are not usually huge by themselves. That is fine. Good tax systems are often built from repeated medium-sized channels, rather than one giant dramatic move. People want one giant secret. The real world is usually dozens of legitimate ordinary and necessary flows captured correctly over time. That is how taxable income gets pressed down without nonsense. Now let me move to the fourth channel, travel. This is where people get seduced most easily because travel is pleasurable and people desperately want pleasurable things to count. The source says travel can become deductible when it is transformed into legitimate business travel with a true business purpose, such as attending an event, filming business, related content, inspecting business or investment property, or holding strategy meetings tied to the operation and growth of the business. It also says that travel must be in pursuit of increasing business income, and that qualifying travel can open the door to deducting airfare, lodging, transportation, and related expenses. Fe phalocite fe turn 39 file 0 fe. That is why I call travel the destination channel. Travel does not become deductible because you brought your laptop. It becomes deductible because the destination itself serves the trade or business. This is another area where sequence matters. A vacation with a little business sprinkled on top is not the same thing as a business trip with some personal time around it. The source stays broad, but the deeper principle is obvious. Purpose leads. If purpose is weak, the whole treatment becomes weak, and that is where a lot of people get themselves into trouble. They try to retrofit justification after the trip has already happened. That is backward. Owners do not retrofit. They structure. They know why they are going. They know what business is being pursued. They document it. Then the expenses flow through the right channel. That is the adult way to do it. And let me add one more point. The destination channel can be very powerful because travel is often one of those emotionally expensive costs people assume must always be paid with after-tax dollars. When it truly qualifies, that assumption breaks. Suddenly, airfare is not just consumption. Lodging is not just indulgence. Transportation is not just life. Part of it becomes a cost of getting the business where it needs to go. That is a very different math problem. Now let me move to the fifth channel, medical expenses. This is where the source becomes especially valuable because it stops treating taxes like a simple matter of deductions and starts treating the business itself as a container for benefit design. The source says ordinary medical expenses can sometimes be deductible even without a business, but only if you itemize and only above certain thresholds, which means many people get little or no real benefit from those costs in the usual personal tax framework. Then it introduces a more powerful idea when the business is structured correctly. Arrangements like an HRA can allow medical expenses to be reimbursed through the business in a more tax-efficient way. And HSAs can also create deductions and tax-free usage when the underlying health plan qualifies. It also notes that health insurance premiums themselves are often deductible for self-employed people, including premiums for spouses and dependents, and recommends making sure those expenses are captured properly through the business books. Fe phalocite, fe turn 39, file 0 fe. This is why I call health the pain channel, because health costs are where many households feel most helpless. They are expensive, they are often sudden, they are often emotional. And many people simply accept that they must be paid from the weakest dollars available. The source is saying something much more important. Health costs can sometimes be routed through stronger channels if the structure is correct. That matters tremendously. A lot of people think tax planning is about small convenience deductions. The most valuable tax planning often begins where life gets heavy. Housing, vehicles, healthcare, children, education, the large burdens. If the business structure can absorb or reimburse part of those burdens in a lawful way, the household changes. That is the real prize, not cleverness, relief. Now, I want to be especially careful here because benefit arrangements do require proper setup, and the source itself says as much, good respect, that the power of a tool is exactly why sloppy people get tempted to use it lazily. Do not. The right answer is not to memorize jargon. The right answer is to understand that the business can become more than a revenue bucket. It can also become a benefit engine. That identity shift is huge. Now let us move to the 6-channel dependence. This is where the average person's jaw starts to tighten because now we are close to the biggest cash drains in the ordinary household. Children, parents, caregiving, and family support. The source says there are compliant ways to route some of this through a business. It mentions employing dependents in the trade or business so that compensation becomes deductible to the business, and it also discusses dependent care assistance plans that can reimburse child care or elder care costs under the right structure and within the applicable rules. Fay Felicite Fay Turn 39 File 0 Fay. This is why I call family support the household channel. Most people support their family with after-tax dollars because they never stop to ask a harder question. Is any of this household burden also legitimately connected to the labor system of the business? That is the question, and the answer, in some cases, is yes. If a child or dependent is actually working in the business in a legitimate way, compensation changes character. If dependent care support qualifies through the right plan, the cash flow changes character. This is a very powerful idea, and it is powerful precisely because the household is where so much money disappears. What the source is really telling you is that the business can sometimes function as a lawful bridge between the household and the tax system, provided the arrangement is real, compliant, and supported by actual activity. That is not a loophole. That is design. And design is how sophisticated people keep more of what they earn. I also like this channel for another reason. It forces you to stop thinking about the business as separate from life. For many self-employed people and closely held businesses, the business is not some isolated machine in a distant building. It is woven into family labor, family logistics, family support systems, and the real household economy. Once you see that clearly, a lot of tax planning stops looking like wizardry and starts looking like accurate classification. Now let us move to the 7th channel, education. This is another area people assume is either fully personal or hopelessly restricted. The source says the IRS recognizes that businesses require skills, training, and education, which means courses, seminars, conferences, trade publications, books, and even some higher education. Related costs can be deductible when directly related and necessary to the business. It also mentions educational assistance structures through the business for employees, which can include family members if they are legitimately employees of the business. Fay Felicite Fay Turn 39 File 0 Fay. This is why I call education the capability channel, because education is not always consumption. Sometimes it is capability acquisition for the income engine. That is a huge distinction. Most people still think of learning as either school for children or vague self-improvement for adults. Owners think differently. Owners ask, does this strengthen the machine? If the answer is yes, then the cost belongs in a different mental bucket. Not because all education is deductible, because some education is directly tied to maintaining or improving business capability. Again, the source is careful enough to keep the logic grounded. The expense has to relate to skills required to operate the trade or business. Good. That is exactly the line to respect. The law is not telling you that every intellectual curiosity belongs on the return. It is saying that capability for the business can be a business cost. That matters because capability compounds. A better skill stack creates better revenue. Better revenue creates more room for deductions. More room creates better after-tax capital. Better after-tax capital creates more optionality. This is how small structural advantages begin compounding into a much larger life. And that is really what this whole subject is about, compounding channels. Now, I want to step back and say something harder. A lot of people will hear all of this and think the point is to turn every piece of life into a deduction. That is not the point. That is amateur greed. The point is to stop paying for business-connected life the expensive way. There is a difference. The expensive way is after tax, unstructured, untracked, and uninformed. The smarter way is to understand what the rules already allow and route legitimate costs through the correct channels before the waterfall reaches the taxable pool. That is the adult version. That is what wealthy people often understand intuitively, and ordinary people are almost never taught. And that is why the source keeps returning to the same basic truth. If you have a real trade or business and a real business purpose, there is often a lawful way to capture expenses people wrongly assume must remain purely personal. Fay file site Fay turn 39 file 0 Fay. Now, let me organize everything into one operating system because isolated deductions are useful. But a coherent system is where the power really lives. I call it the expense conversion protocol. First, identify the trade or business, no channel. Second, identify the real household costs that may also support the business space movement, conversations, destinations, health structures, dependent support, capability building. Third, classify each one by rule, not by wish. Home office vehicle usage, business meals, business travel, benefit arrangement, dependent employment or care plan. Education tied to business capability. Fourth, build the paperwork and payment flow correctly. This is where many people fail. They understand the idea and then let the execution remain sloppy. The source repeatedly implies the importance of making sure expenses are properly captured in the business books. That is exactly right. If the business is going to do the work for you, the business must actually see the transaction. Fay file site Fay turn 39 file 0 Fay 5th. Respect the line between life and business. Even while using the channels intelligently, crossing the line carelessly turns strategy into fiction. And fiction is expensive. That is the protocol. And once you see the system this way, the whole game changes. You stop asking, can I write off my life? That is the wrong question. You start asking, which parts of my life are already supporting the business, and how do I route them correctly so I stop overpaying tax through ignorance? That is the right question. Now let me tell you the deeper lesson. Taxes are not only about rates, they are about classification. Two people can earn the same money and live in the same city and have very different after-tax outcomes, because one understands how to classify and route costs through the correct channels and the other does not. That is not unfair, it is simply reality. The system is full of categories. The people who learn the categories pay less friction. That is why I care so much about structure. Not because structure is glamorous, because structure changes survival. It changes how much money stays in the household. It changes how quickly capital accumulates. It changes how hard the waterfall hits. And once you understand that, the phrase write-offs starts feeling too small. This is not about writing things off. This is about restoring leverage to the household. This is about refusing to let every important cost in life be paid with the weakest dollars available. That is the real upgrade. Now let me leave you with the hardest truth in the whole story. Most people do not overpay taxes because they are foolish. They overpay because nobody ever taught them that the business is not only a source of income, it is also a tool for reclassifying how life gets funded. That is the hidden lesson in the source. The business is the container. The expense channel is the mechanism. The tax waterfall is the battlefield. And the person who understands the order of the water keeps far more of it. That is why I do not want you thinking like a taxpayer anymore. I want you thinking like a systems engineer. Where is the income entering? Where is it being classified? Where are the ordinary and necessary channels? What is supporting the machine? What is being paid with weak dollars that could be paid with stronger ones? Those are the questions. And once you start asking them, you stop living under the tax system like weather. You start navigating it like terrain. That is how you win here. Not by hiding, not by pretending, by understanding which parts of life can become business, supported, and then routing them lawfully before the waterfall does what it always does to the unprepared. That is the whole trick. Not a loophole, a map. And once you have the map, it becomes very hard to go back to paying for everything the expensive way.